So today we are looking at the ethics, which was where we stopped yesterday. Since many of us have already discussed the major parts of the ethics, I'll just run us through it, right? And so that we can go to today's topic. Now, ethics. Ethics has to do with human character, human conduct. All right? Ethics has to do with what is right and what is wrong. Okay? I'm getting some echo somewhere. Can that person please mute?
Mr. Suleiman,
I think it has stopped now. Okay. Now, ethics has to do with morality, what is right, what is wrong. It goes beyond compliance with laws and regulations. And that's why ethics is different from law. Something can be ethical and still be illegal. Something can be legal and still be unethical. I have examples for that too. Okay? Now, when we say ethics, we are referring to something that is morally right in all situations. When you look at it, this thing makes sense now. That is ethics. Okay? And the accountancy profession is committed to acting ethically and in the public interest. Anything that will protect the general public is what ICANN is all about. Okay? Not just ICANN, all the accountancy profession, the IFAC, the ACCA, the ANAN, what else, CPA, CFA, every one of us, even CITN, CIBN, stockbrokers, all of us, we are here to protect the public interest. Okay? Now, you can now have ethical dilemmas. When we say a dilemma is a state when you don't know what is right and what is wrong. Am I right? Am I right? Is someone there? Okay. Okay.
Yes,
If
sir,
my
you're right.
side is not noisy, you can unmute, please. Okay. Remember, I like a conversation. I like us having a conversation. We are already familiar with this topic. It's just for us to have that conversation and learn more from it. It's not something we are memorizing or something we are learning for the first time. Okay. So let's just discuss. Okay. Now, ethical dilemma will now be a state where you don't know what is right or what is wrong, and you are in a situation of two answers, and any of these answer you go for is ethically correct. Any of the answers you go for is right. So it often arises when conflicting responsibilities to employers, to clients, and even to the public occur. So you have two things that are ethically right that you can do for your employer, that you can do for your client. If you do this, it is right. If you do this, it is also right. That is ethical dilemma. Do you understand? Aha. Now, this is not a case of your employer asking you to falsify your financial statement. No, that one is not ethical dilemma. That one, they're asking you to act in an unethical way. That one is straightforward. Ethical dilemma is that if you choose A, you are right. If you choose B, you are right. Some people will get hurt in A, while some people will benefit from it. The same thing if you choose B, benefit, while some
That's the story, sir.
Sir,
I wanted to ask him.
go ahead, sir.
Can you please give an illustration where we can have ethical, something that's ethically right and it is actually it's not legal, and something that is legal that is not ethical. Can you example?
I didn't get the question very well. Are you asking of example of ethical dilemma, or what is legal but not ethical?
Legal but not ethical.
Okay, now let me give you an example. The example is very close to us. Now, last year, when the hardship was very much, do you remember a time someone is using typewriter or typing on a keyboard? Do you remember a time when the National Assembly said they wanted to buy a new aircraft for the president? Let's leave the aircraft alone. When they were buying SUVs for members of the National Assembly, do you remember that time?
Yes, we do. We
When they
did.
were
I think
buying
that was,
SUV for members
yeah.
of the National Assembly, we remember, right?
Yes, we did. We did.
Now,
Yes.
that purchase of SUV, was it ethical? Does it make sense to us?
Oh no.
Was it ethical? Like, due to the suffering, a lot of us were going through shaggy then, right? A lot of us were going through hardship. That hardship was very strong then. It was very, the economy was very harsh on everyone then. And then National Assembly was deliberating on buying aircraft. If it was now they deliberated on buying aircraft, do you know we might not prosecute them, we might not say anything, we might be silent. But as at that time that everywhere was very hot, do you think it was ethical for them to bring up a matter of buying SUV for their members? Was it ethical? Remember, I need response. We will not move if you don't respond. We will not move from here. Was it ethical then? Does it make sense to us? Was it morally right?
Sorry, right then.
Eh? I can't hear you. Who else is online? Someone should please unmute. Please speak.
Pausing.
It's morally right. No, it's not morally right rather. At that point, yeah.
So it didn't make any sense to us. Mr. Kenny, please, you don't need to raise your hand. Just speak. Talk to us, please. You don't need to raise your hand because I am not looking at the page. It is now I'm on the page. So until I come to this page, before I see anyone raising up his hand, if you have anything, please just go ahead. Talk to us.
All right, sir. Thank you. I think with respect to buying the SUV, there is no. It's not really morally right.
So
But
to
I
us
think
then, anything that doesn't make sense to you is not morally right. It is morally wrong. If it doesn't make any sense to you, then it is morally wrong. Looking at it in the general perspective, not just your own subjective one, then it was wrong. If you ask anybody, it was wrong, especially at that moment, the heat of the period, it was very wrong, right? But was it legal? Was that purchase legal? Do you think members of the National Assembly is entitled to an SUV? By law, are they entitled to it?
Yes, they are entitled to it based on for the movement, for their movement.
Yes. So which means by law, they were entitled to it. Legally, the purchase was right, but morally, it was wrong. Now that means that morality can be right at a particular situation, an action can be morally right at a situation, and can still be wrong at another situation. But of course, morality has to do with in all situations it is right. But of course, there are still some situations that some things are not morally right. So that's the difference between morality and legality. Okay? Now, another case is where someone is going, you are taking someone to the hospital, a case of life and death, and you take a one way. The police try to stop you. You ran, you didn't stop for them. Do you understand? Now, was that legal
No, it wasn't legal. It
or
was
was it
illegal.
moral?
It was moral
It
because you are
was
trying to
moral
save a
because you had
life.
to save a life.
Yes.
And ensure, please make sure nobody loses another life in the process. So the fact that you're taking one way. Do you understand? So that is morality and ethics.
Okay.
Okay, so that's it. Shall we proceed now?
Yes, sir.
Okay, now we look at the ethical codes of conduct that we have, ethical codes and guidance. All right, whereby it was published by IFAC in their handbook, okay, and national bodies like ICANN, ANAM, CITN, CIBN, everyone has adopted it. So we call it the ICANN's Code of Conduct. It's the same thing, okay. Now, it has an impact on members in practice and also on student members. This code of conduct, the principle, the fundamental principle is the same thing for all of us, whether you are a student or you are a member in practice or member not in practice. Do you understand? So every one of us, this code is binding on us. Okay? Now, what are these codes? The principles. Number one, integrity. You have to be honest, you have to be straightforward, you have to be truthful in your dealings, in your professional dealings, in your business dealings, even in your personal dealings. That's integrity. And you need to avoid information that is materially misstated or that is misleading. A false information, a reckless information, information that omits certain disclosures, important figures. Okay, you need to do away with that. Then also you have to be objective. You need to avoid bias. You need to avoid conflict of interest, whereby your own personal interest will now conflict or will now go against the interest of the general public, the interest of the company where you work, the interest of the community. Okay, then also you need to do away with undue influence. Don't let anybody have an undue influence on you. Do you understand? So having an undue influence, that is bribery. Okay, yes, don't let anyone have an undue influence on you, and ensure that your decisions and judgments remain independent and professional. So whatever decision you make professionally and independently is right. Okay, so that's it. Then also professional competence and due care. Of course, you have to be up to date. You need to keep learning. You need to increase your skills. Go for trainings, symposiums, and the rest of them. Okay, you need to provide competent service whenever you are discharging your service. Whenever you are delivering your duty, whenever you are discharging your duty, you need to show that professional competence when you are delivering, okay? And it must align with the latest standards, the laws and techniques. You need to engage in continuing professional development. That is CPD. ICANN also has that. Once you are chartered, you get into that. Then you need to perform your duties diligently. Diligently. So these are the things we have. Okay? So that's it. Now, we are also to look at professional behavior. Yeah. Okay, no, confidentiality first. Confidentiality says that you cannot disclose information you obtained in the discharge of your duties, information you obtained about your client. You can't disclose it to another person, not to a third party, not to their, what's it called? Their competitors. Okay, so that's what we have there. Now, in the discharge of this, okay, this information cannot be disclosed. Of course, there are situations where you can disclose, which was one of the things our lady earlier said, that you can disclose it when it is required by law, yeah, and also when it is permitted by law, okay, and also when you have the authority to disclose. Now, can I ask a question? What's the difference between permitted by law and required by law? Can someone give us an example? Permitted by law and required by law. Is there any difference between the two?
I think for permitted by law, in that instance, let's say, for example, a client committed fraud, and the enforcement company, EFCC agency, bring a circular for investigation, and you need to disclose the information of that client. So I think that one is permitted by law.
No, that one is not permitted by law. To report a crime is required by law.
Okay.
Hello, can I say something about
Go
that?
ahead, sir.
I think, yes, sir, thanks. I think when we say that's required by law,
Uh-huh.
I think that one speaks to like compliance stuff. I think that one is speaking to compliance requirement. And when we
Okay.
say permitted by law, I think that one is speaking about unrestricted rights to do something in certain situation.
Okay. Okay.
So
So
that's what I.
permitted by law is that law permits you, you can reveal it. For instance, now I'm discussing something about one of my clients. I just mentioned that, okay, I have a client, and this client, I had to do this. I told you some things about the client that are relating to what we are currently dealing with in the class. I did not mention the name of the client. I did not mention any name at all. You don't even know any of my clients. Do you understand? In a situation like that, it is permitted. I am allowed. Insofar, I do not disclose the key information. Do you understand? It is permitted that, okay, you can give out this information. Insofar, it is not against the law. Okay? If the client gives me permission, then I'm also permitted by law. But what is required by law is that when you see a crime, you must report it. That one is a requirement. It is not a permission. When you see a crime, for instance, in the course of discharging your duties, you realize that your client is into money laundering, or your client is into terrorism financing, or they are using this kidnapping ransom to finance the business, and they are now using money laundering to cover it up. A situation like that, you are not permitted by law. You are required. It is a must you report. But permission is that, yeah, okay, the law permits you, it's not against the law to do so. That is permission. Okay? Then another case is when the client gives you the authority to do so. Okay? Now those are the three main cases. I think we have one other case when you can review. Okay? So to answer a query, of course, in those three cases, those are the three main reasons when you can disclose. And that is that. Shall we proceed? Shall we
Yes,
proceed?
sir. Let's.
Okay, so you
Yes,
are going
sir.
to use this information for your personal advantage. Okay, that's it. Now, professional behavior is the fifth one, which means you comply with all laws and regulations. Anywhere you find yourself, act according to the law. Okay, act according to the law. Are we there, please? Are we there?
Yes,
Yes,
sir.
we are.
Okay, so that is it. Anywhere you find yourself, act according to the law. Anywhere you find yourself. Then also avoid any action that will bring disrepute, discredit to ICANN. Don't do anything that will not say, I thought you are an ICANN member. Don't do anything that will bring discredit to our profession. We have been protecting this. Okay? Then also treat others with courtesy and respect. So that is professional behavior. Okay? Now, we have threats to ethical principles. Now, all these ethical principles that we have, confidentiality, professional behavior, all of them, there can be a threat to it. And some of the threats are just like we have mentioned, we have self-interest threat, that is your personal interest, conflict of interest. Okay? So that interest is when your personal gain affects your professional judgment. All right, you have a financial interest, you have a concern for job security. You know that if you report this thing, you might lose your job. Okay, you are expecting a bonus, and because of that you have to do some things and all of that. So all those things, they are self-interest threats. Okay, and they have to be avoided. Then another thing is where we have self-review threat. Self-review threat is when you review your own work, the work you have done, and you are here to review it. So when you are reviewing it, of course, that's a self-review trait. When you review it and you realize that there was an error in what you did, you prepared a financial statement for your client, and then you are still the one to audit the financial statement. So if the financial statement, can you say that that financial statement was not properly prepared, does not show a true and fair view? It means your work is wrong. So because of that, you might not be able to reevaluate yourself professionally or objectively. So that is a self-review trait. Then also you can have an advocacy trait. An advocacy trait is when you promote a client, when you act as an advocate for your client, when you defend them in court cases. Okay, so in a case like this, it can compromise your objectivity if care is not taken, if you want to defend them. But this can only be acceptable if the information you are providing at the court of law, if the information you are providing is true and fair, and you are not under any influence, any undue influence. You are not being influenced, okay? So that is it, and you are not being threatened. That is advocacy trait. Then we have familiarity trait. Of course, familiarity trait is the wife of the CEO, okay, or the son of the chairman, who can say something and can make some decisions, or you need to give them preferential treatment. Okay, so when you receive gifts or preferential treatment like that, or you let's say your wife is the accountant of the company you are auditing, your husband is the internal auditor, or your husband is the COO, Chief of Operating Officer, then how do you prepare a financial statement to say that such company is not showing a true and fair view? Okay, so that is it. Right? Shall I proceed, please? Shall we proceed?
Yes, sir. Yes, sir.
And I hope I'm not too fast.
No, yes, please.
Okay. Now, that is that. Then also we have the intimidation threat. Intimidation is when they are threatening you, when you are being coerced, you are being bullied to do an unethical behavior, to commit a crime. All right? Yes, that also happens a lot. Okay? Now, or you as an auditor, external auditor, you are threatening that, see, okay, if you don't complete this audit assignment, you don't get your money, and you need the money. That is intimidation threat. Okay? And when you are overbearing personalities and attempting to influence decisions. So that is what we have here. Okay? So those are the threats, ethical threats we can have. All right. Now, accountants in business. So if you are an accountant, what is expected of you? Number one, you have a role of preparing a financial information, a financial statement. Okay. So what do we mean by this financial statement? You prepare your income statement, your statement of financial position, your cash flow statement, all right, your statement of changes in equity. All these are to be prepared by you. So that's what we have. As an accountant, you are expected to do all of that. Then ensure that your report shows a true and fair view and all is technically correct. Please, all information is technically correct. But challenge can come from your senior managers, whereby they will be asking you to inflate your revenue, inflate the profit, all right, or to reduce, to understate your expenses so that you can be recording higher profit. Now, when a case like that comes up, then you need to run. But you can't run when you've not gotten another job now. May God help us. So that's it. Then also, you are to handle any misleading information. you are to handle it, and you have to be very wise when you are handling these things. Okay, you have to be very, very wise. Now they're asking you to inflate financial statement figures in the account. You don't just come out and say, this thing you are doing is wrong. I will report you. I will leave your job. If you leave my job, do you have another one outside? Do you understand? So those are the things you need to be professional about it. It is not everything you fight. I understand the law. The law will not give you another job. So that's why resigning is not always the first thing to do. It is usually the last resort. Okay? And that's what we have there. So you must not prepare, you must not follow what they have said, and you must not be associated with misleading information. If you are under a pressure and they are bringing it like that, you need to evaluate the threat. Is this something you can avoid? Look at it very well. Can I avoid it? If you can avoid it, then you can apply some safeguards. Like you can discuss it with your internal auditor. If you think your internal auditor is involved, you can discuss it with your chief operating officer. If you think he's also involved, you can discuss it with your external auditor. Consult your audit committee. All right? If your auditor cannot do anything, your external auditor, if they cannot do anything about it, inform ICANN, inform your professional body. Let them know what is going on. They'll be able to advise you. So even if you lose your job, those people will be willing, they can tell you that don't worry, just leave the job and come to us. Then they can now report such a company. Okay? Now, if all of this is unresolved, all right, nobody is listening to the other, then you can resign and then inform authorities. So it is wrong for you to resign and not inform authority, even though this is Nigeria. You can inform the authority and the authority will come and arrest you. Well, it's not a joke. I will not say that I'm just joking. I'm not joking. It happens. You inform authority and the authority will come and arrest you. So I'm not joking, though. I'm not capping at all. So that's it. So you just need to be careful when you are reporting cases like that, because especially those who are in Abuja, you don't know somebody who knows somebody who knows somebody who knows somebody that eventually knows somebody. So that is it. Now we have something called conflict of interest. Now, conflict of interest is whereby your personal interest conflicts the interest of the company where you are working. Another case you can have conflict of interest is where your professional obligation conflicts your employer pressures. Your employer is bringing so much pressure to you. You shall want to kill you. All right. Now, because of this so much pressure, you might be thinking, no, please, let us do this. Let us consider this. Let us consider this. All right. Yes. Now, conflict like that can arise. So some of the form of this pressure can be for you to act against the law, for you to provide a misleading information and submit it to tax authorities or to CAC, or to lie to pension commission, lie to them that you have paid pension or you are paying pension, whereas you have not done that. Okay, all those things can occur. Then also there can be an issue of misrepresentation of financial statement. All of this you need to guide against them. Okay. Then the safeguard can be to seek advice as well. Then you engage audit committee, consider legal advice, and resign where necessary. Now the practical examples are also there. Please, you can go through the examples. All right. Now today we are looking at the conceptual framework for financial reporting. I hope we can proceed to that. Shall we?
Yes, sir, we can. We can, sir.
Okay, for the conceptual framework has to do with the concept that guides preparation and presentation of financial statements. Okay, preparation and presentation of financial statements. Now, We have an introduction of GAAP, which is the generally acceptable accounting principle that encompasses all accounting concepts, accounting principles, conventions, rules, and laws that are used in preparing the financial statements. I believe we've talked about this gap yesterday. All right. So a conceptual framework is a structured set of interrelated concepts. Okay, interrelated concepts, and these concepts, okay, the concepts are what we have done before: accounting concepts and conventions, accounting principles that will now underpin our financial reporting. They are the ones to guide the preparation and presentation of our financial reporting. Okay, so that's what we have there. Okay, now in March 2018, the International Accounting Standard Board issued a revised conceptual framework, and although it is not drastically altering IFRS, but the updated framework enhances clarity and consistency. So these are the things we have here. Okay, now in our conceptual framework, we have the objective of we have the chapter 1 to chapter 8, and chapter 1 talks about the objective of general purpose financial reporting. Okay, so what's the objective? Okay, yes. So under this objective, it provides useful information to investors, to lenders, creditors for resource allocation decision. So to tell you that, okay, you can invest your money into this business, or please don't invest your money into this business. All right, all these are there. Then also, it helps users to assess future net cash flow. What are you expecting? What's your cash flow? Okay, then it also assesses entities' resources, claims, and management performance. So we have all of this there. And also, the financial statement provides financial position, financial performance, changes in equity and cash flow. These are financial statements that we prepare under this the objective, general purpose. Okay, now also the chapter 2 talks about the qualitative characteristics of useful information, and here we'll be looking at the relevance. Under the fundamental qualitative characteristics, we have two things under it. We have the relevance and we have the faithful representation. Relevance is that information provided must be relevant to what is going on. Hello, information must be relevant. Give us information that will enhance our decision making, that is relevant to our decision making. If I want to make a decision about whether I want to continue to be an investor, I want to look at your financial performance. I want to see the money you have generated. Okay, so that is that. Now, I hope I can proceed. I hope I can proceed, please.
Yes, please.
Okay, now, so then also this information must include predictive and confirmatory value. Predictive and confirmatory value. So that's what we have there. Then under the faithful representation, we are looking at your information must be complete, it must be neutral, and it must be free from error. Faithful representation. It must faithfully reflect the substance of transactions. So that is what we have there. Then also under it, we have the fundamental qualitative characteristics, and we also have the enhancing qualitative characteristics. And under this enhancing, we have comparability. Information provided should be comparable to another company, all right, or another financial year. Okay, then we should be able to verify the information. Also, the information must come in handy as at when it is needed, and we should be able to understand the information they are providing to us. Okay, so that is that. Now we have the chapter 3 that talks about the financial statement and the reporting entity. Financial statement and the reporting entity. Now, the financial statement. Objective of the financial statement is to provide information about assets, liabilities, equity, income, and expenses. Right? Am I right? Those are the things we are looking for in our financial statement. Asset, liability, equity, income, and expenses. Those are the 5 things. Right? Now we have perspective, of which reporting is from the point of view of the entity itself. And of course, we are assuming that an entity will continue to operate, will continue to exist in the foreseeable future. Okay, that's the going concern concept, the going concern of a financial statement. A financial statement that is not showing this going concern means that the company is collapsing, right? Am I right, please? Are we there?
Yes, yes,
Yes,
sir.
we are.
So that is it. It means that the company is collapsing. And when company is collapsing like that, once the going concern concept, once the going concern cannot be validated, then there is a problem. There is a huge problem. It means that the company will collapse, and of course, the what do we call them? The shareholders can decide to take their money. They can withdraw their money before the company collapses. Then also, the reporting entity can be a single entity. It can be part of a company, and it can be a group where we have parent and subsidiary, right? So that's what we have. Now we have the element of the financial statement, just like we said. There is a difference between components and elements. I don't know if I'm making any sense here. There is a difference between
Yes, sir.
components and elements. Elements are assets, liabilities, equity, income, and expenses. Components of a financial statement are your income statement, statement of financial position, cash flow statement. All right, those are the components. Now, we have to look at how do we recognize assets, liability, income, expenses, equity. How do we recognize them? Okay, now for recognition criteria, it includes an item in the financial statement if it meets the definition. If the financial statement meets the definition, then you put it under the recognition criteria. Okay, then also previous framework requirements. And the framework requirement is that before you can say one item, for instance, an asset, there must be probability that economic benefit will flow into the entity. There must be a probability that money will come into the entity or money will go out of the business. Do you understand? So that is probability. Then also, you must have a reliable information to measure it. The available information must measure the must be measurable. You should be able to measure it, be able to quantify it. Okay, so that is it. Now, the new approach focuses on definition and measurement and not probability. So the previous framework says that you have to measure, okay, and also there must be a probability of economic benefit. So that's it. Now, how do you de-recognize? You remove. The recognition means to stop recognizing, to stop recording a transaction. Are we there? So to stop recording a transaction, that is what we have there. So you are to remove all or parts of a previously recognized asset, liability, income, or expense, or equity from the item, from the financial statement. Are we there, please?
Yes.
Yes, sir. Yes, sir.
So that is what we have here. Now, we have chapter 6 that talks about measurement elements. Measurement of element. How do we measure all these items? Your income, your expenses, your liability, your asset, your equity. How do we measure them? Then you can have the initial measurement and subsequent measurement. Okay, so then you can have different bases. Historical basis has to do with the cost. Okay, the cost at which you purchase that thing. Do you understand? So that is it. The historical cost on the date of purchase, that's the historical basis. The current cost, if you have to buy another one to replace what you currently have, how much? Then we can also have a fair value, which is the current value. We have a net realizable value, which we use when we are selling off a business, when there is no what is this thing, this concept you mentioned earlier?
Going concern.
Going concern, thank you. Okay, so that is it. Are we there, please? So that is what we have. Okay, you can also use a present value where we have value in use, and then you have to discount it. So all these are allowed. Then of course historical cost is the most common one. Now we have presentation. So the four elements of IFRS or even IAS. Okay, the first one is what? Recognition. Second one is measurement. Third one is presentation, while the fourth one is disclosure. Now the presentation now is that if it is an asset, present it in financial position. Liability, financial position. Income and expenses, income statement, right? Equity, financial position, and statement of changes in equity. Are we there, please? So all these are what we have. Okay, so that's it. Now this presentation serves as a communication tool to enhance relevance, faithful representation, and understanding, and be able to compare the financial statement. Okay, being able to compare the financial statement, and then you have to avoid unnecessary detail or excessive aggregation. Don't give us information that we don't need. All right, so that's what we have here. Then also you have to lay emphasis on objective and principle over a strict rule. Okay, so that's it. Now we have key principles that provides entity specific information. Okay, now also we have to avoid duplication. Okay, so that's it. Now we also have to disclose using meaningful classification and aggregation. Meaningful classification and aggregation. So that's what we have here. Now when you are classifying, you can classify based on nature, based on function, based on measurement. You can also avoid offsetting unless it is permitted. Offsetting has to do with liability and assets. You knock them off. Okay, so I'm owing you 1,000. You are owing me 1,500. Of course, we can cancel it and say that you are owing me 500 and I'm not owing you anything. All right, that's what we have. Okay, so that's it. Shall we proceed? Shall we proceed, please?
Yes.
Yes, sir.
Yes, please.
Okay. What was the time? Have we gone beyond our time? We have to end this class at 10, right? I mean at 8, right?
Yes, sir. Yes, sir.
Yes.
So I'm not using your time. I'm still using my time, not your own. So once it is after 8, that is when I start using your own time. But right now, it's still my time. You give me my time. So that's it. Classification is based on nature, function, and measurement. Okay, and we have to avoid offsetting. Okay. Now we can have special classification for equity components, but they are subject to legal restrictions. Okay, income and expenses also can have special classification, especially when we split it between profit and loss account and other comprehensive income. Okay, yes, we have that, and we have example of that. So let me give you an example where you have exchange loss, gains or losses on foreign exchange transactions. Okay, if it is a gain, you will have it in your profit and loss account, but if it is a loss, you will have it in other comprehensive income. So when there is a split like that, we call that a special classification. All right, and that is it. Now aggregation can be grouping similar items together for summarization. All right, you can have that in your asset register as well. Then balances between too much detail and too much summarization can also affect your aggregation, but you have to be more detailed. You need to give more detailed information. Okay, and you put that into your notes. All right, are we there? Are we there, please?
Yes, yes.
Okay,
Yes.
then the chapter 8 of that material talks about capital maintenance concept, whereby uh, profit is earned only when closing equity is greater than opening equity after adjusting for capital contributions during the year. All those things, they are just English. Okay, so that's it. Now, we also have physical capital maintenance, whereby profit is earned only when operating capacity, not just the financial value, operating capacity is maintained or increased, whereby you produce more. Okay, and this excludes new capital raised after and after dividend. New capital you raise or after dividend has been shared. No, we are not talking about those ones. So that is that. Now quickly, I think I've mentioned this IS1. I don't want to go into it again. Aggregate. We've talked about aggregation where we said you have to itemize similar transaction, right? Why dissimilar transaction should not be combined together. We've discussed all of this before. I think I'll have to skip them now. Now, where departure clause. Okay. Okay, in your fair presentation, true and fair view. Okay, we'll not discuss this. So our exception rule is here under the offsetting. So let me quickly go into it. Offsetting, like I said, is generally prohibited. Assets should not offset against liabilities, and income should not offset against expenses. Okay, but of course there are exceptions whereby a specific IFRS permits or requires offsetting. For instance, the IS12 allows offsetting deferred tax and deferred tax assets and deferred tax liability. Deferred tax is that this is the tax I will pay next year. Don't worry, this tax I'm not paying now, I can pay it next year. Now, when it can be an asset, it can be a liability. It can be in the form of, okay, this I have money to be claimed from tax authority, but I'm not claiming it now. I can claim it next year. That is a deferred tax asset. It is an asset because it is claimable. It is waiting for you. Okay. Why a liability is when you are supposed to pay and you don't even want to pay. Okay. So that is it. Shall we proceed, please? We can
Yes.
proceed, right?
Yes.
Okay, that
Yes.
is that. Now, I think we are done with that. Offsetting rule, the game and loss and all of that, please. Now, the fair presentation versus true and fair view. And I think I have mentioned something like true and fair view before. Okay, so that is it. Now, for to present fair presentation now, to present fairly, okay, it means that your financial statement, your financial position, your financial performance, your cash flow, have been prepared fairly. Okay? Yes. And when we are saying fairly, it means you have applied all IFRS standards and any additional disclosure you have considered them. Okay? That is fair presentation. Okay? Now, we have disclosure requirements. Disclosure requirement is that when you fully comply with IFRS, you must state it clearly that yes, we are IFRS compliant. Your auditor must state it in the audited financial statement that this company has complied with IFRS completely, fully. Okay? And an entity cannot claim IFRS compliance unless you meet all the applicable requirements from IFRS. Alright, that's it. So we can have a rare departure clause whereby extremely rare, whereby when you apply IFRS to that particular transaction, it will not show a true and fair view of the state of your company. That is, when you apply IFRS law, it will mislead those who use the financial. All right. So in a case like that, which is very rare, but of course it happens. In a case like that, then you can depart from IFRS. All right. So that is that. Now, so the entity must depart in such a situation if it happens, but you must disclose the nature, the reason, and the impact of that disclosure. You need to state it in your notes to the financial statement. You need to state it there. Okay, the impact of that disclosure. If you do not depart from that standard, what will be the effect on your financial statement? Okay, so that is it. Now, IS1 on presentation of financial statement, we've discussed that before. Okay, the components are here now. All right, I told you about elements earlier. These are the components: financial position, income statement, statement of changes in equity, cash flow, notes, comparable information, opening statement of financial position. Others are auditor's report, the chairman's report, the CEO's report, all those things. They also form financial statements. So that is that. Now, the financial position, balance sheet. I can proceed, right? I can proceed, right?
Yes, sir.
I hope I'm not too fast. I hope
No,
I'm not
sir.
too
No, sir.
fast.
So now it's not reduced. So when they were
Okay, that person is saying something else. He's not talking to us. Now, still the financial position, IS1 requires classification between current assets, non-current assets, current liabilities, non-current liabilities, and equity. Okay, then presentation in order of liquidity. You can do that current and non-current assets and liabilities, or you present it in order of liquidity if you have more reliable or relevant information. And then to disclose, yes, if line items mix current and non-current accounts together, you need to disclose how much is expected to be recovered or settled after 12 months. For instance, you have a case of lease payment. No, not lease. Let's say deferred payment or hire purchase. Okay, or even lease. Let's use lease. Hire purchase is no more recognized. You don't use hire purchase anymore. Do you understand? So if in your higher institution, if you visit your alma mater and they are still treating them hire purchase account, it is wrong. Many of us did that thing in our NG2. Ask Mr. Ibrahim, we did it and we felt it very well. The Polytechnic Ibadan, and of course, it was one of the most beautiful things we learned at the Polytechnic Ibadan. Trust me, our lecturers there, they are top notch. I can say it anywhere. Do you understand? So they taught us those basic things, but now hire purchase is not useful, and Those of us who know it, what do we do with it? We can't, there's not even being to trash it. But of course, you never can tell. A law can still come in the future to bring back the higher purchase. Oh. Do you understand? So even though IFRS or IS is not recognizing higher purchase, and now we focus on lease, taxation still recognizes higher purchase. Oh. That doesn't mean they don't buy and sell things in higher purchase. Higher purchase transactions does not record business. That's not what it means. Oh. It still goes on. Oh. FIRS, that starting from January 2026, we start calling them NRS, abi? FIRS still recognizes higher purchase. Oh. Under your CGT, capital gains tax, you still have higher purchase. So FIRS has not abolished that. Now, when you buy an item and you are paying in installments, now let's say on lease. So I purchase an item of generator on lease. Okay, I've made my deposit, or I've made the lease payment for this year. Now the lease payment is to run for 6 years. Now I have paid for this year. Let's say I'm paying in advance. The one I'm paying for next year is a liability, right? Am I right?
Yes, yes.
But what type of a liability is it?
The current.
A current liability, because it's
Current
less than
liability.
12 months, right? So if it is less than 12 months, it means I have to record it separately. Current liability, lease payment of the same asset, generator. Then I'll now go to my non-current liability and I still have the same lease payment after deducting the one I have paid this year and the one for next year. The remaining figure will now be in non-current liability. Am I right? Do you understand what
Yes.
I just said?
Yes.
So that is what we are saying about line items being separated. Okay, you need to tell us how much is payable within the next 12 months and how much is payable after 12 months. You need to separate them, even when you are mixing the line items together. Okay, and that is what we have there. Now, the minimum line items that must be shown. Your PPE, of course, you must have it. Intangible asset is not part of PPE, but they are also non-current assets. Am I right?
Yes, sir.
Intangible assets are not PPE. They are not tangible. So they will not form part of your PPE schedule, your assets register. Right? So PPE is there, intangible assets is there. Then we have, if you have any financial asset and liability, you put it there. Inventory is there under your current assets. Trade receivables, trade payables, provisions, all these are there. Okay? Then issued capital, reserve is there. If it is a group account, you must show NCI, non-controlling interest. Right? If you have your goodwill, your purchased goodwill can be different from other intangible assets. But of course, they are all intangible assets. Okay? You can put it together under intangible asset. That's your purchased goodwill. And apart from purchased goodwill, there's no other goodwill that will be recognized in your finance, that will be presented in your financial statement or in your financial position, or please. Okay? Now that is what we have there. Now, additional line items should be presented if relevant to understanding. All right, if you know that showing additional line items will provide more understanding, then of course you can present. Okay, now for your P&L account, you have two components: profit and loss account and other comprehensive income. Profit and loss account is where you have your revenues and expenses. gains and loss not recognized in P&L. For instance, your evaluation, your foreign exchange, yes, they can be in your OCI. Okay. Now we can have another one for a single statement approach. Okay, the presentation option is a single statement approach or a two separate approach. The two separate approach is that P&L and OCI. Then the minimum information you must have revenue, you must have cost of sales, you must have finance costs. Another name for finance cost is what? Anybody?
Interest.
Interest paid, yes. Interest
Interest.
Yeah, interest paid. So that is that. Then also we have tax expenses, right? We have profit and or loss, profit or loss, profit or loss. Then the component of the OCI, items not can be grouped into items not to be reclassified in P and L, reclassified to P and L. For instance, your PPE revaluation surplus under IAS 16, and when you have revaluation surplus, and when you are using evaluation method for PPE and not cost method. Okay, and also we have items that may be reclassified. For instance, foreign exchange gains and loss under IS 21. You can have all of that. Okay, now all these examples, please, I'll skip them. Now we have statement of changes in equity. Statement of changes in equity. If you have seen the statement of changes in equity before, I like using a bank as an example, because they are one institution that will always publish their account. For instance, if you need for Access Bank from any year, up to this, I don't think many companies has posted its first half of the year. No, because we are still in July, right? We call that, what's the name for it when you prepare your financial statement and you even audit it in the first half of the year? What do they call it? What do you call the audit?
Interim.
Sorry?
Interim.
Thank you, sir.
Interim.
Interim financial.
Interim finance.
Yes, you can have an interim financial statement. You can also have an interim audit. Interim audit is the audit of the financial statement. Okay? Now, in your statement of changes in equity, you will see the opening balance there. You will see the changes during the period, during the year. And what are these changes? Your profit or loss for the year will be there. Your other comprehensive income items will be there. Owners' transactions like dividend. Don't forget, changes in equity. Equity belongs to shareholders, right? So if you have paid them any dividend, it will be there. If you have issued out any share, it will be there. If there is any share buyback, it will be there. What is a share buyback? This is a professional class. You guys will answer question tire. What is a share buyback? I'm waiting.
When you repurchase share, you use
When you purchase what?
share you use.
Okay. So shares that have been issued out, when you purchase it, when you buy it back, when you are buying it back from the shareholders, that is that. Okay. Now you also have the closing balance. You will see the closing balance as well. So transactions with owners are not shown in the comprehensive income. Okay, they are not shown in the comprehensive income. So, but they do not impact equity and are highlighted in the statement of changes in equity. So that's that. Now we have the notes to the financial statement. For your notes to the financial statement, like I said, it is a narrative report, a storyline. You sold so number of goods, so quantity, and that amounted to this. English storyline narration. You are narrating a story. That is notes to the financial statement. Giving a note to support what you have presented. Okay? To support your note to the financial statement will now cover all the other disclosure requirements now. Your note to the financial statement is your disclosure requirement. In that note, you will now disclose your recognition criteria and the recognition, your measurement, initial measurement, subsequent measurement, it will be there. Your presentation, it will be there. You need to state it. Everything is what will be in your notes to the financial statement. And then in that note, you explain judgments, your estimates, your accounting policies. For instance, when you're talking of financial position, you'll be looking at the non-current asset. In that non-current asset, what's your accounting policy? Okay, what's the depreciation policy? Are you using a cost basis or the valuation basis? Okay, then if it is a cost basis, what is the depreciation policy that you have used? What type of depreciation? Okay, then how did you arrive at that? If it is revaluation method, who are the valuers? Are they professional valuers? So all those things, those are the things you put it. You can see that it's a real storyline. So that is it. So all your estimates, everything you've done in the financial statement, you give a report on it. And that's what we have. Now the required disclosures are, I've mentioned it before, measurement basis, okay? The significant accounting policies, the judgment, all those things are to be displayed. Then also your key assumptions are there, your nature and carrying amount. Carrying amount will be there. Another name for carrying amount is what, please?
Net book value.
Thank you, sir. Net book value. So, and you can only have net book value when you are using cost basis. Cost minus depreciation, or cost minus accumulated depreciation. That's where you have your carrying amount or net book value. Then also your sensitivity analysis. For those who did PM, sensitivity analysis is that analysis that allows you to think like a pessimist. You think like, what if? You call it a what if analysis, So what if this one? What if our profit, what if our sales is not up to this? What if our profit is this? What if this one happens to us? What happens? Do you understand? So that is what we have there. Now, also, range of possible outcomes. If you have any court case that can result to a contingent liability, the range of the possible outcome, you need to weigh it. If we lose this court case, we have this, we pay this amount. If we win it, we have this property. You need to give us the range of possible outcomes as well. So when there is a change in your assumptions from the prior periods. So for instance now, we've completed the audit of 2024. For those of you who have not completed the audit for 2024, you know you are paying penalty, right? Just keep your 25,000 for this month. And if you don't pay it within the next 12 days or 13 days, you have 31 days in this month. It starts from 20 now. If you don't pay within the next 12 days, then keep additional 5,000 to make it 30,000 because you will pay. So you will pay to FIRS late filing, and that's that. Okay? So when there is an assumption you used in 2024 assessment year, no, let me not use assessment year because we are not in transition class. 2023 financial accounting year end. If there was an assumption you used, and in 2024 you did not use the same assumption, then you need to state it. Okay? The assumption can be in terms of your future interest rate. When you are doing your present value, so what's your discounting factor? What's the interest rate, future interest rate you have used? Salary growth rate, inflationary impact, useful lives of an asset. Do you understand? So for instance, let's say your asset, there is this asset, let me say, computer equipment has usually been recorded over time under furniture and fittings. Do you understand? And computer equipment is an equipment. It's not a fitting, it's not a furniture. Okay? So if you are putting it under furniture and fittings, it means you have been using 5 years as its lifespan. I don't know if that makes sense. 5 years would have been its useful life, 20%. Okay? Now you have reclassified it and brought it back to where it belongs to. which is under equipment, computer equipment account. And that one, the useful life is 4 years. When there's a change like that, you need to state it in your disclosure requirement. Okay. So for your capital disclosure as well, you need to tell us the objectives and processes of capital management. Okay. How did you manage your debt? How did you manage your equity? Okay. Externally imposed capital requirements and whether they were complied with. If there was any law from CAC or from FIRS, okay, or even from IFRS, you need to state it. You need to disclose the quantitative information about the capital policy, the qualitative data, capital level you have, that is, what is the level of capital you have in the business, the consequences of non-compliance if there's anything. You need to state it, okay? Then also you look at the interim, we talked about interim financial statements, right? Yes, IS 34 guides us on interim financial statement. This can be quarterly or biannually. Okay, so that is it. And of course, it is not mandatory. It is not mandatory. So that's it. And the regulation itself does not tell us that it must be quarterly or it must be half yearly. No, it is not mandatory, and it is determined by national regulation. So, example, we have the UK Financial Services Authority that requires listed companies to file half yearly and annual reports. Okay, yes, we have that one. And they encourage half yearly report, which is the interim reporting, 60 days within 60 days of the period ending. That is, if you are using January to December, right? It means that June is your half year, right? So 60 days after June is what? The end of August. So by the end of August, you must report your interim report, which is of course what we are expecting next year as well, right? Now I told you that most of you do not have to get that because we start seeing it next month. Now, forms, because that interim report has to be audited as well. We have interim audit as well, right? For those of you who did the audit in your skills level, you have interim audit. Now, the form and content of that interim financial statement. Okay, you have a condensed statement of financial position, P&L account and OCI, changes in equity, cash flow, and selected explanatory notes. Selected notes instead of complete notes to the financial statement, right? So those are the things we have there. Now, looking at EPS, of course, earnings per share, we have basic earnings per share and we have diluted ones. When you get to EPS, we will discuss that extensively. All right, so that's it. Then also periods for which interim report must be presented. We discussed this, which is 60 days after. Okay, it's because they all go together. Now that is that. Now examples, please look at the examples. I hope I'm not too fast. Should I slow down? Do you need me to slow down?
Yeah, good sir.
Okay. Now we have recognition measurement principles, which we have discussed before. Estimate, use of estimate. So yes, we use estimate when we are preparing interim reports because you don't have the full financial information, so you can only use estimate. And interim reporting in Nigeria, we also have, it is governed by SEC, Securities and Exchange Commission, and the Nigerian Stock Exchange, which is now known as the Exchange Commission. Okay, the Exchange Commission. Then also we have to comply with SCAMA, Investment and Securities Act, and IFRS standard. It can be done quarterly, okay, which must be filed within 30 days. If you are using quarterly report, if you are preparing your interim report quarterly, then 30 days after March, let's say January to December now, right? 30 days after March, you must report it. Then the P&L, it must be signed by the CFO or CEO, published in national dailies. That is for those who are in what do we call the stock exchange market. Then, of course, all the informations are still the same there. Now, the last thing I want to touch today is related party disclosure. I think that's the last thing we have here. Yeah, related party disclosure. So what is a related party? Can anyone help us? What is a related party? Yes, a related party disclosure. What do you understand by related party? Yes, I'm listening. Related party. What do you understand by related parties?
Is a transaction of arm's length which you must disclose in a financial statement. You have a social transaction
Related
in line
party
with
is
IS
transaction at arm's length.
24. Yes.
Related party is not a transaction at arm's length. Who is a related party?
Okay.
Related party is just like a close relative, someone that is close, probably your spouse, your friend.
Related parties are parties that are closely related, like a group and a subsidiary, or is
Uh-huh.
their transactions are within parties that are closely related.
Parties that are closely related. So what are these parties that are closely related?
Like a group and its subsidiary.
A group and its subsidiary. Uh-huh.
An associate,
An associate.
a joint
Okay.
venture,
So all
a
these they
joint
are also
venture.
in group. Group and subsidiary, they are all in groups. Okay. Associates, yes, they are also there. Now, all these items,
Can we say
okay,
partnership?
partnership business. Now, this group, related parties, their transactions will not be at arm's length, whether you like it or not. Such a transaction is not usually at arm's length. It is assumed normally that for related parties, their transactions are not at arm's length. Okay, and that's it. So if it is not at arm's length, what does it mean? It means that you are doing paddy in your transaction. Do you get it? You are doing paddy in your transaction. So now your financial statement should disclose if transactions are held on at arm's length on normal commercial terms. Now I usually say this to my tax students, that the fact that I sold an item below the market value does not mean it is not at arm's length. It does not mean it is a related party transaction. Does that make sense? Do you understand what I'm saying?
Say that again, sir.
The fact that a transaction did not occur at arm's length does not necessarily mean it was done, it was a related party transaction. In taxation, we call it connected persons. Okay? So, why do I say this? Let me give an instance. When something costs 5 million naira in the market, but you sold it to your related party at 4.5 million, yes, we call it a related party transaction, right? Am I right? Because
Yes.
you sold it below
Yes.
the market price, and also to someone who is connected to you, right? Okay, fine, that's fine. But it is not all transactions that I sold at 4.5 instead of 5 million. It is not all transactions that are connected transactions or related party transactions. Now, there's something called bargaining power of supplier and customer. Am I right?
Yes. Yes, you're right.
Do you
Yes,
understand what
yes, you're right.
bargaining power is? You know what bargaining power is? Your CSMA, at
Yes.
least many of you did CSMA before you got to CR, before you got to professional stage. Now, bargaining power of supplier and customer. What if my related party, my related person, connected person has a bargaining power over me? and then I sold below the market price. That's one. Number two, what if if I don't sell to my related party, I'll be incurring expenses like selling and distribution expenses. Now, I have a subsidiary who wants to buy from me. The subsidiary is just beside my office. So I can produce here and sell the whole component to my subsidiary. What do you call it? Transfer pricing. I can transfer the whole thing to my subsidiary, and my subsidiary will buy it at 4.5 million. Now, instead of 5 million naira that I would have sold it outside. Now, by taking it outside to the market, I'll spend on selling and distribution expense, right? I will incur selling and distribution expenses. I will incur commissions, sales commission, and all of this can also amount to 500,000. Now, would you now say that the transaction between me and my subsidiary is still a related party transaction? No, it is not. So, but that one is you go explain tire, and that's why you need to disclose it. You need to disclose it extensively, and sometimes, according to advanced tax, sometimes you need to discuss this with tax authority ahead of time, before the time comes up. You can have an arrangement with them that I'll be selling to my subsidiary, and this is the amount I'll be selling to it, and the tax authority will approve it. So these are the things. Okay. Now, related party transactions are transactions that are not at arm's length. Okay. Yes, they are not at arm's length. They can be very misleading. They use it to evade tax. Group companies, they use it very well to evade tax. Okay. Yes, a subsidiary can sell to a parent company. Okay, a parent can sell to subsidiary, and like that. Now, objective of this IAS 24 is to ensure that financial statement draws attention to the existence of related party. That's why you must disclose that related party, and the transactions between you and the balances between you and that related party must be disclosed. Okay, so it is a disclosure standard only, not a measurement or recognition standard. It is a disclosure standard, not a measurement or recognition standard, and that is it. You don't need to measure it, you don't need to recognize it, just disclose it in your notes to the financial statement, and that is what we have on that. Okay, now a party is related if he has control over your entity or is being controlled by another entity. Okay, that's a related party. Then the person has a significant influence. It can be an investor, it can be an associate. The person can also have a joint control, and the person is under the company. The party is under a common control. It can be a fellow subsidiary. Any of these can bring out, it can make a related party. And it can also be a key management personnel or a close family member of the key management personnel, or a close family member of everyone we have mentioned, like a subsidiary, an associate, like that, or even a joint venture. Okay, so that's it. Now, usually, a lender is not a related party. Your bank is not a related party. Trade union, public utilities, government departments, major customers and suppliers, they are not related parties. They are not related parties. Okay? So let us understand that. Now, close family members, we know who they are. Now, related party transactions can now be sale or purchase of goods and services or assets. It can be rendering or receiving services. It can be a lease. It can be loan and financing. It can be research and development. It can be guarantees. It can be debt settlement on behalf of an entity. So those are the things we have. Any question from anyone? So before you ask your question, let's go to the disclosure requirement. So you have to disclose the name of that related party, the name of the parent, the ultimate subsidiary or subsidiaries, sub-subsidiaries if there is any. I said sub-subsidiaries. If there is any joint venture companies, whatever you have, you need to disclose them. Okay. Then also the nature of the relationship, the transaction amount, their standing balances, the provisions for doubtful debt, expenses recognized for bad debt from related parties. If there is any bad debt from a related party, you need to disclose it separately, because it is assumed that you want to steal that money and you don't want to pay tax, you want to evade tax. Now, any question, please? If you have any question, kindly disclose your question now. Any question from anyone? Any question from anyone? So in the absence of question,
Hello,
continue from,
sir.
yes, I can hear
Hello,
you.
sir. Can you hear me?
Yes.
Yeah, my question is under this ethics. That's professional behavior,
Okay.
which talks about complying with the law. So I really want to understand: is it the law of the profession or the law of the land in which the professional accountant probably is operating?
Okay, so one thing is very common there. The law of the profession, the law of a professional body will never go against the law of the land. Okay? So we are referring to the two laws. Don't go against the law of the professional body and don't go against the law of the land. And don't forget, the law of
And
the
it's not
professional body
possible
is
for both
consistent
to
with the law of the land.
contradict each other.
Sorry?
I said it's not possible for both to contradict each other.
It is never possible.
Okay.
Because any law any professional body wants to establish has to be signed. It has to be approved. So you not just bring a law that will now contradict to what the law of the land says. No, you will not do that. It is always impossible. Law of professional body, I'm not talking of international law. Law of professional body to the law of the Nigerian constitution. It will never, and I'm using never here, it will never contradict. Okay? So that's it. Any other question from anyone?
Hello, sir.
Yes, sir.
Hello. Concerning the materials, are we going to have it immediately we finish this lesson, or
The center will share the material with you. Just go to their
immediately?
mail, they have a way. And I guess we can stop our recording now. We are done with this class. Right? You have any other
Okay.
question? Any other question? In the absence
Hello,
of
sir.
question.
Mine
Yes.
is more like mine is more like an inquiry. Okay, it's now obvious that ICANN has changed its syllabus, and I could see that some topics in this SBR are not in the corporate reporting. So, how can we get materials to be reading ahead on
So
these new topics or modified topics they've
is to wait.
introduced?
I understand your question. So what you have to do is we need to wait for ICANN to bring their own material. I thought I heard one rumor earlier this week that ICANN has updated their this thing, but I think that one was just a rumor. But of course, let's expect ICANN material to do that. And don't worry, it will come soonest.
Hello, sir.
Yes, sir.
I have a question concerning the election, concerning the ICANN.
Okay, sir.
When they inaugurated this presidential administration, that is the ICANN president,
I can't hear what you are
I
saying.
had,
I think you are opening the door and it's disturbing what.
okay, what I'm